Well, welcome to the podcast today, and we're going to continue our story and all our information about the things you need to know about buying a property and finance. And lots of you, I'm sure, get bombarded on the internet, on emails, on YouTube, asking about self-managed super funds and buying a property. And it isn't as easy as they make it out. It is fantastic if you do it right. So I thought, why not go to one of the lenders in Sydney that specialises in funding self-managed super fund purchases. Jason Howard from the Mortgage Tree, welcome to the podcast, buddy.
Thanks, Rob. Great to be here with you today and to have a little discussion about self-managed super fund borrowings and how that can help people build up their investments for the future for when they do retire.
So we're going to be talking a lot of things about investments and all that today. And what people must understand is everything we talk about today is general. When you are doing a self-managed super, when you're doing your super, when you're doing your investments, you should always go and get independent financial advice. We can react to what you give us, but in the end, you need to go and get that advice that suits you, because everyone's tax situation is different. Their goals are different. So always go and seek a professional, and they will set you on the right path. First, what is a self-managed super fund?
A self-managed super fund is a super fund that a person will set up for themselves. It has to be set up as a trust deed, as if you would be setting up a family trust or a discretionary trust, where you would hold your super within that self-managed super fund and manage it yourself. So you can hold a property within a self-managed super fund, you can hold direct shares within a self-managed super fund, bank accounts within a self-managed super fund, and also you can have managed investments within a self-managed super fund. It basically just means you're managing your super yourself instead of having it in the hands of a an investment fund manager like a retail fund, like an AMP or so forth.
So a lot of people can split their super funds, can't they? They can have one managed by their local financial planner and then have a separate one if they've got money, and they can hold properties in that under the self-managed super fund. So you can have multiple funds, can't you?
You can have multiple funds. What I do recommend to people, if they are looking at a self-managed super fund, is obviously go and get professional financial advice, first of all, from an accountant or a financial advisor before they go and proceed to set one up, so they can understand all of the costs and the workings of a self-managed super fund before they take the plunge into setting one up. The other thing in regards to the self-managed super fund, if you do want to buy a property, it has many advantages. I guess we can discuss a lot of that in the podcast today.
We can, yeah. And look, a lot of people, I always say to people, if you're going to build up a property portfolio using a self-managed super fund, make it a balanced portfolio. So buy a house, buy an office, buy a factory unit. If you're in the ability and you have the money there to do it, spread it out. Don't buy everything in the same town. It's what we call spreading your risk. And it also gives you sometimes properties go up, other areas go down. But when you sell that property, the money's got to go back into the super fund. You can't pocket it and go over on a big holiday in Europe.
Or Thailand.
That's where you've always got to go and get, if you always want to get advice, that's the most important thing. Because once the money goes in, that's where it stays.
Exactly. It's not like a regular bank account where you can start pulling the money out and spending it on other items that you may use for personal living expenses or recreational expenses.
And so you can't live in the property you buy in your self-managed super.
No, it has to be an arm's length investment property. You can actually have family members rent the property from you, that's fine, but you cannot live in the property as your primary residence.
Yes, but there is another way you can use them. If you are buying an office or an industrial unit, many people will buy that industrial unit or that office in their self-managed super and then have their business lease the property from the self-managed super. So it splits them. It sort of negates the risk. If one doesn't work, they've still got the property, they've still got the asset. It's a way of risk mitigation, as you call it, and it's totally legal, completely legal.
Yes, you can do that. On a residential property, you can't, but on a commercial property or industrial property, your trading business, for example, if you're running a business, that business can rent the commercial office from you that's owned by the self-managed super fund that you own, that's totally legal. You can have your own business operating out of your self-managed super fund commercial property.
So, and of course the lending rules are very different when it comes to self-managed super, and there's not a lot of banks. So how many lenders are there that will lend in a self-managed super fund to purchase a property?
These days, they're all non-bank lenders that are doing self-managed super fund loans. All of the banks have decided to get out of self-managed super fund lending. These days, there's probably around 8 or 9 lenders in the market that are doing self-managed super fund loans quite well on both commercial and residential properties.
And it's the same, what we call LVR, loan to value ratio, the same?
Most super fund lenders will cap out at 80% of the property value, which is similar to any other residential lender, but there are restrictions in regards to properties, locations. So some of these lenders do put population restrictions on the regions where they will lend. But as far as what lending ratio you can go up to on a property, most of them do cap out at 80%, although there are a few lenders that have increased recently to 90%.
Wow.
Yeah, not many. There's 2 or 3 in the market that are actually at the moment going up to 90%. But because there's no mortgage insurance in self-managed super fund loans, they do charge their own risk fee. So the costs are a lot more, plus the interest rate does go up.
So the higher the LVR, the higher the risk fee?
Yes, the higher the risk fee, plus interest rates go up as well. So unlike residential lending where you could have a loan that's at 50% with a lender, it's going to give you the same interest rate as if you were borrowing 80%. Okay?
Yeah,
so the interest rate's not going to change whether the LVR changes, as opposed to super fund loans. If you're doing a 50% super fund loan, the interest rate's going to be more favourable as opposed to an 80% super fund loan.
Okay.
They do see the rates tier down.
So it depends on the risk, relates directly to the interest rate and the risk.
That's correct.
And the fee.
Yeah, that's
Secondly, under self-managed super, does the property have to be positively geared?
Not necessarily, but it is beneficial if it is. Obviously, you want to have a property that can pretty much pay for itself. It's not going to draw too much money out of your own pocket, but it's not a necessity because depending on how many members you have in your super fund, the members will make contributions to the super fund as well. Plus, you may have other investments earning interest as well. So it's not imperative that a property is positively geared. It can be slightly negatively geared, provided you're going to see the capital returns at the end of the day when you dispose of that property.
So this is why you and I were talking before about it's so important to do a lot of due diligence. Get in financial advice from an accountant or a financial planner. Go to a good mortgage broker. Go to a good buyer's agent. And you need to put all your ducks in line really before you even decide which property you're going to get. I mean, we have a client that's been working 6 months to get everything in line before they purchase a property.
Yes.
Because they want to make sure they're buying the right property for the right reason, and that is so important. When it comes to self-managed supers, how long is the process? If you decided today to set up a self-managed super and then buy a property, it's not like, if I send a client to you, if they've got everything lined up, within about a week to 2 weeks, you can have their loan approved subject to the property. You can have just about everything done for them. It's not that quick but for self-managed supers, is it?
Depending on the setup of self-managed super fund itself, the trust deed, you just need to meet with your accountant or financial advisor to go through who are the members and who's going to be the trustee of the super fund.
Yep.
To set that up doesn't take a lot of time. That can be set up in a day or two. But the process from there to finding a property, it's really depends on individual circumstances, because you may decide to take do more due diligence and really investigate what's out there, where you want to buy. You want to look at the regions, the locations, the rent return that you're getting, the yield on the property.
So I'm not going to interrupt you there. For people who don't understand, what is yield?
Yield is your rent return based on the value of the property that you've purchased and the annual rent. So basically, say you're buying a property for $500,000 and that's giving you a return of, say, $25,000 a year in rent.
Yep.
Well, basically you divide the rent by the property value, which will give you a 5% return.
Which is, now that is in residential.
That's
People
residential.
don't understand. In commercial and offices, it's totally different. Yield is net because majority of people, when they rent a commercial property, pay all outgoings.
Yes, yes.
Not every time, but 99%.
It depends
of the
on
time.
it depends on what's negotiated on a commercial property. In a lot of cases, the tenant will pay a lot of the outgoings, such as the rates, the water, insurance, those types of things. It really depends on what's negotiated between the tenant and the landlord that owns the property. So that all has to come into play as well. So if you're fortunate enough to own a commercial property where you can have 100% of your outgoings paid by the tenant, because you might be giving them a slightly favourable rent, for example.
Yeah, so you put the rent up, you've got to pay the outgoings.
Yes.
You can drop the rent if they're paying the outgoings.
That's exactly right. Yeah. Exactly right. So you may look at a commercial property where you might be comfortable with a 4.5-5% yield return, but the tenant's paying 100% of the outgoings. So you don't have any additional costs. So that's advantageous for the landlord.
Yeah, that's true. Now, with your experience and people coming to you to buy properties through self-managed super, are they traditionally buying residential or are they buying offices and industrial units?
It's a mixture of both, particularly when you're dealing with clients that are self-employed and running a business. They may decide to look at a commercial property or industrial property and have their business rent that property from the super fund.
Which is very common.
So basically, they're the tenant and the landlord, so to speak. So it's the best of both worlds.
You wouldn't want to have a dispute with yourself, would you?
No, that's right. It makes it much more favourable for people to do it in that instance, because they don't have to negotiate with a tenant. Okay, so they can set the rent at a reasonable level that the business will pay, that they know that they're comfortable their business paying, and it's going into their own super. Okay, and because you know it's your business and you're the tenant, you know that the property's being looked after as well. So,
well, you would hope so.
Yes, and in a lot of cases, you don't need to involve a real estate agent either in the lease process.
Yeah, you can get standard forms in most states now for that, and it's but some people do. I know that we've rented a property that we owned to a relative, and she wanted a sweetheart deal, and I knocked $5 off and went no, and I said, and by the way, you're signing a normal rental agreement through a real estate agent. She said, why? And I said, because this is business. You can get caught. You have a fallout within the family, or you're renting it to your niece and their niece's mum has a fallout with your wife, or vice versa, and all of a sudden, if you don't have legal coverage, you can't do anything, and it gets really nasty. So while you can do that, I always say every time you must have a rental agreement, either through a real estate agent or not through a real estate agent, but you must have that legal coverage.
I think it protects both parties there. And
that's what I said to her.
Exactly.
Yeah. What are some of the traps, before we wind up today, that people don't realise, or mistakes they make when they're going through self-managed super fund to purchase a property?
Okay, some of the mistakes that people can make is people may decide to look at buying a property in a self-managed super fund. But before you even do that, you need to look at how much deposit you have within your super fund.
Oh, yeah.
So
sometimes convert it to cash, don't you?
That's right. So, for example, this is the most common thing where someone has a retail fund that they've worked for an employer for, say, 20 years. They've built up maybe, say, 250K in super. They decide that they want to buy a property in a self-managed super fund, so they go ahead and set up the self-managed super fund. They then have to transfer a large portion of that money from the retail fund into their self-managed super fund.
Yes.
Now, to do that, before you can even do that, you have to go and set up a bank account for the self-managed super fund. So many of the banks out there will have accounts for self-managed super funds. So you can set that up with any of Australia's major banks, Macquarie, ING, all these banks out there, smaller banks as well, have accounts for self-managed super funds. So that's the first thing you need to do. Once you've got the super fund set up, you need to go and open up a bank account for your super fund. That's where the money will then be transferred across from the retail fund into your self-managed super fund. Now, I always would say to clients to get financial advice before you set these up, but one thing in particular you need to look at with a retail fund, most people's retail funds will have a level of life insurance cover, total and permanent disability cover. Now, if you decided to go and close that retail fund and put everything into your self-managed super fund, you're going to lose your insurance.
And we spoke about this at the start. We said you must have a balanced portfolio. And that's not us giving advice. That's what the financial planners that you and I deal with tell everyone every time. You want to go and do super and buy property, fantastic. But you must have a balanced portfolio. And part of that is your insurances.
Exactly. So if you're someone that has a retail fund and you've been with your employer for X amount of years, you might have changed employers but kept the same retail fund and moved it with you, you would have life insurance cover. Now, depending on how often you review that cover, you would need to maintain that retail fund with a level of funds within it that will still pay for that insurance cover on a yearly basis. Okay? So if anything goes wrong, you've still got that insurance cover in place. Now, to go and set it up again and you're over 50, it's going to cost X amount of dollars to set up.
You're probably get knocked back.
Well, that's right. There could be, you may have health conditions now that prevent you from getting life cover. So if it was something that was set up 20 years ago when you're a younger person, these insurance covers are a lot cheaper to maintain over time than to go and set up fresh.
Well, I actually know someone who has had one of those policies and she had cancer about 20-something years ago. But the policy was set up before, and it was a life insurance, whatever you call it, term life, whatever. Now, if she leaves the fund, she can't get that life, even though 100% cured of cancer, as much as she can be. She can't get insurance.
No,
but if she stays in the fund, she has life insurance.
Exactly.
And if she hadn't investigated it, she could have made a fatal mistake when it comes to your life insurance. So we're going to wrap up today. You do specialise in self-managed super funds.
I do specialise in
What else do you do?
I do the broad spectrum. I've been a mortgage broker for almost 10 years now, and that's after a lengthy banking career. I was in banking for almost 24 years and worked for some of the majors in the Australian banking sector, business and commercial banking. So I do home loans, investment loans, business, commercial property loans, motor vehicle, equipment finance, even a little bit of property development stuff as well. I deal with private equity firms that will lend for people that are property developers. That's quite popular these days, seeing that the banks out there are people that find it much harder to lend money to people that are looking at investing and building a property development and so forth. So there are many private funders in the market that I deal with that will actually help people that want to do a property development. So
where do people find Jason?
They find me at themortgagetree.com.au, or my mobile number is 0410 477 511. I'm a Camden LGA local. I live in the area. I work in the area, but I have clients all over Sydney, all over Australia. I've been in this game, as I said, all up 33 years. And as I say to my clients, if I don't know what I'm doing by now, I should give the game away.
Well, that's why. Isn't that why you call it the mortgage tree? Because as they say, money grows on trees?
That's right. Money grows on trees. And my little slogan also is, I'm your mortgage broker for life.
Oh, dear. Well, on that, I've got to go on that one. Thanks, everyone, for listening to the podcast. Brought to you, of course, by Lansdowne Property Group, the area and one of Sydney's leading what you call these days pretty well broad range buyers agents. So we buy commercial, residential, rural, anything you like, we can get it. You have a great week and we'll catch you on the flip. Bye-bye.
Bye-bye.